Canadian dollar has been on a downward slide, dipping to its lowest level in nearly 3 weeks on Monday as oil. Sticking with currencies, the Canadian dollar has been on a downward slide, dipping to its lowest level in nearly 3 weeks on Monday as oil prices fell as well, and investors weigh the prospects of aggressive rate hikes to tackle inflation. Joining us now is Adam Button, Chief Currency Analyst at Forex Live. Thank you for joining us, Adam.
Hi, Jackie.
So I wonder, there's a lot of attention. We're going to talk Canadian dollar, but there's a lot of attention on the U.S. dollar right now because of its recent strength. So can you walk me through why it is as strong as it is?
Yeah, I think to put it into perspective, the dollar is really at extraordinary levels. We're touching just now 24-year highs against the yen. Other than a few days around Brexit and the pandemic, it's a 38-year low for the pound against the U.S. dollar. The euro is approaching parity once again. So, the dollar is truly extraordinarily strong right now. And the main reasons is that the Fed has been the first off the line in hiking rates, and we're pricing in an increasingly hawkish Fed. If you go back just maybe a month ago, we were pricing in a 50, 50, 25, 25 basis point hikes from the Fed. Now the market's pricing in 75, 75, 50, 50. So in just a month, 100 basis points of extra hiking. Couple that with fears of a global slowdown and a flight to safety, and everyone is just piling into U.S. dollars as fast as they can. As bad or as the U.S. outlook has been deteriorating, but if you look at Europe and even Canada with the housing market, that has been deteriorating more quickly. So it's a case of it being the safest place and also the best of a bad group.
So if the expectations have increased to those levels, like you mentioned, the possibility of a 75 basis point hike tomorrow, will there be a reaction to it, do you think, in the U.S. dollar, or has that sort of already happened?
Yeah, I mean, these Federal Reserve events have been extraordinarily volatile. The market gets into this sort of second order and third order kind of thinking where you say, okay, if 75 is priced in, well, then do we see a little bit of a relief rally from that? Or even if 100 basis points is the talk a lot of times. So there was a risk of that and the risk of the Fed saying we're going to keep going. I think a lot of people are looking at Powell right now and saying there's no way he can come out and be anything but ultra hawkish. The problem is that the Fed has lost so much credibility on inflation that they can't come out and say, listen, global growth is slowing down, supply chains are improving. We think that in 6 months, inflation is going to come down. Because they've been so wrong for so long, they almost have to stand up there and say, listen, we're going to keep hiking no matter what. We're going to keep, we're slamming on the brakes here. And so, the market is sort of struggling to see past that. And when that comes, maybe there is a bit of a relief rally in some of these assets that are beaten down, because a lot of that has obviously been priced in the last few days. But it's ultimately extremely touch and go. And I think you just see a lot of investors going to the sidelines, be it in bonds, be it in stocks, taking down leverage. And that's really been the price action in the past week.
Yeah, so you're seeing a lot of people, though, pouring into the U.S. dollar. What could reverse that enthusiasm? What could be the sort of tipping point in the other direction?
Yeah, I think, at some point you say, inflation is coming down. Global growth isn't so bad. I mean, we're looking out now and we're saying, okay, maybe it's a recession with 8% inflation. Well, 8% inflation, say you have nominal growth at 7%, inflation at 8%, well, that's negative 1% real growth. But it's still 7% nominal growth. If inflation were to tick down, you were to start to see sort of the market's just looking for that report where inflation in the month-over-month term starts to slow down. And when that comes, you'll say, okay, the world needs a lot of what Canada is selling, for instance, in terms of commodities. Balance sheets are still pretty good in terms of households and in terms of corporates. People want to spend coming out of the pandemic. So it's really going to take a turn in data, especially inflation data, for that to happen. And then we start to say, okay, maybe pricing in the Federal Reserve going to 4 or 4.25%, maybe that's a little bit aggressive. So let's top it out at 3.5, and then the dollar will come down, and people will start looking to put money to work again.
really so much hinging on these inflation prints that we watch for. But okay, so as other central banks, catch up to the sort of speed that you laid out, that could potentially be ahead for the U.S. Federal Reserve. So if Canada continues hiking in a big way, what could that mean for other currencies like the Canadian dollar?
I think it's an undertold story in the Canadian dollar and how well it's done this year. Until 2 days ago, the Canadian dollar was the best performing major currency in the world. It's really neck and neck with the US dollar right now, and that's because the Bank of Canada is a little bit ahead of the Federal Reserve. Now, I think what's happening really in this past week is we're saying the Bank of Canada is going to hit a ceiling, and it's probably 3%, and the Fed might go to 4%. And the reason for that is housing. Everywhere you look now, there are signs of a pretty dramatic slowdown and reversal in Canadian housing, something we've been talking about for a while. And the Bank of Canada, right now, the Canadian 5-year is up 100 basis points just in the last 3 weeks, not even 3 weeks, 2.5 weeks. And so when people are looking at mortgages, you can still get around 4%, but that's going to go to 4.5%, 5%. This is a sudden, dramatic stop in Canadian housing. And the Bank of Canada isn't going to hike in that. So that sort of possible spread with the U.S. is growing. But at the same time, Europe's slowing down more dramatically. The Bank of Japan is not hiking at all. So there's still lots to like at Canada, and oil has held up incredibly well for a period of a slowdown in global growth. And if that is truly a supply shortage like it looks, there will be a lot of money flowing into Canada. The terms of trade look very good for a number of months ahead.
So longer term for the Canadian dollar, if like you mentioned, the Bank of Canada does hit that ceiling and can't keep up the pace as much as, say, the Federal Reserve, at the end of the year, I don't know how you do your forecast, but what are you expecting for the Canadian dollar down the road then?
Yeah, I think longer term, this decade is going to be all about building things and commodities, and that's going to be a great thing for the Canadian dollar. I think we're at the end of that first or second inning in that, and it's time to take a break. Once there's a bottom in Canadian housing or a flattening in that, that'll be the time to come back into the Canadian dollar. And I don't think that's going to be this year, or at least not until late this year. So we'll probably see, we're around 77 cents now, we'll probably see 73 cents. That'd be the time to start getting back into the Canadian dollar. Ultimately, Canada is a pro-cyclical country, a pro-cyclical currency. And right now the cycle has gone from sort of a slowdown in growth to a soft landing to probably a hard landing in a lot of economies. And, maybe we're seeing the worst of that now, but I suspect we still have at least a summer's worth of negative headlines along those lines. And that's going to keep the pressure on the Canadian dollar to the downside.
All right.